Hi, my name is Jim Keenan. I'm with Keenan Private Wealth Management in Midtown Manhattan. Today, we're going to talk about the U.S. economic situation and the outlook in times of uncertainty. As you can see here, GDP growth forecast 2.2%, core inflation 3.5%, 30% chance of recession, and 10 plus effective tariff rates. Now, I want to illustrate the fact that right now there is a lot of uncertainty in the market. There have been policy changes and military actions that have affected the market on a very short term basis. I'll give you an example. Today, when the president announced the Straits of Hormuz going to be regulated by the U.S., the market for oil went down to the 70s. Now I believe it's back up to the 90s again. And that's within a very short period of time. So if we're looking at a very close camera to the economic situation, it's almost ridiculously indeterminable on a day by day and even hour by hour basis. But what's interesting about the oil shock and the markets is that the markets have really been very resilient. Well, there's been volatility, but on a week by week basis, there's been some downturn, but really not that much. We see some signs of unemployment slowing and inflation. We made this slide just last week. I would say it's a little more than sticky with the price of oil, above 100 at some times. But we don't know again what's going to happen, and these times are very, very uncertain. The consumer is cautious, but has not really gotten affected too much yet. Okay, inflation. It's a war-driven surge with inflation. I mentioned about the CPI right now. It's about 3.3, 3.25%. That's the highest it's been since May of 24. So you know that this is going to affect markets, but again, not that much so far. The Federal Reserve, well, they're holding steady. Even though the administration really would like interest rates to go down, the probability of that happening, and it's reflected in the bond market, is that interest rates are actually going up. Mortgage rates are going up, CD rates, municipal rates. How long that will last, we don't know. And there's going to be a change with the Federal Reserve chairman, but probably there can be no downward move. Okay, the consumer. There is a dichotomy in the economy between the upper end income consumers and the middle and lower incomes consumers. I read an article about how the 1% is actually become much wealthier as the market goes up. Their assets are in equities, and has been a positive wealth effect and increased spending. They have a large amount of savings, and they're getting wage growth. Also, the difference between a CEO and an average worker has become much more than it has before. On the other side, middle income consumers, they're being affected directly by tariffs, and of course the price of oil. Lately, I just went to the gas pump and I was a bit in shock about that. and the consumer on the middle and lower income end is not saving. They don't have as much money, and they're starting to use credit more, which is kind of upsetting and has a ripple effect. Also, in affordability of housing, for instance, in our area, in the metropolitan area, the average single person cannot afford to get a even a studio in the metropolitan area here, and that's reflected more or less in other parts of our country. Okay, the AI investment. Um, I was just listening to the head of Goldman Sachs, and I agree with him because he's my age or older and remembers these things. But when we had the dot com bust, it was overdone, and PE ratios were um, were high at that time. Now, go forward to the AI bubble, if you want to call it a bubble. It's a different kind of economy. It's a different kind of technology. It's a technology that moves much more quickly, but similarly to the dot com bust, companies you see now will may not be around in the near future, and it may be quite hard to predict which companies would gain the most in that area. And take you can take the obvious ones like Microsoft, Apple, any of those that you can think of. It's not necessarily going to happen that they will be the lead. They do have the most money. In AI, the cost of growing is very high. So if you look at the Wall Street firms uh, on the left side, and Main Street cannot really afford the kind of investment that can really move the ball with the technology of AI. And they don't have as much borrowing or equity pools to get into. Um, Costs from tariffs hit their margin more than the large guys. Um, there's policy uncertainty, and capital investment decisions are crucial. And small medium businesses, they're pretty much mostly excluded from the really great gains that the bigger guys have. So the fiscal policy, stimulus now, risk later. I was looking at fiscal policy for China recently just to make a comparison, and China is heavily invested in AI. And most of the investment in AI in China comes from the government. In the US, it comes from private equity or public markets. But the way it's going now is that tax cuts are extended, and that front loads the deficits. Add on top of that the cost of the Iran war. And eventually, this can affect the stimulus would wane at some point, and deregulation, which has a positive effect. It's unlocking private investment. The markets have moved very quickly and quite a bit towards private equity. These deficits will eventually affect the economy, and it may have a negative effect in the future if we don't get there's a theory. I remember the trickle down theory. If you give rich people a tax cut, it's supposed to trickle down to jobs and opportunities. I'm not so sure that would apply, but if it does, we'd have a different look into the future. But right now, it looks like all these deficits and costs of the war could have a very negative effect. Okay, best case scenario is that GDP can go up 2.2%. We have some Fed cuts. Bull case is GDP goes up over 3%. Inflation would be stickier, and they would pause some of the cuts. The bear case, which I think could be more probable, is a negative GDP eventually, as I mentioned, due to the front loading of deficits, inflation lingering, and the Fed having emergency cuts. There's a term that years ago that I studied was called stagflation. And stagflation was inflation with a recession. That was during the 70s. Hopefully, we don't see that, but that could be a negative situation. So, what we're looking at here in conclusion is growth continues, but unevenly, and uncertainty for sure is the new normal. So we have to look at things as they develop. One of the things in geopolitical studies I've had is, you have the Straits of Hormuz, you have Taiwan, you have the Russian war, you have, people forgot about North Korea. They have nuclear weapons, but the point I'm trying to make is there's so much uncertainty in the world, and anything out there could cause a conflagration. We have to be careful and keep to what's going on. So, and I think we should look at consumers. Are they spending? Are they taking on too much debt? And the labor market, which has started to weaken a little bit. Thank you for listening in. You can leave a comment on the bottom, or if you want some information, you can go to KeenanPWM.com and send an email to us, and we'll get back to you.